Hello everyone, this is Ryan Mallory for SharePlanner. After a pretty bullish week, and which came really at a surprise for almost all traders, I think the way that we had ended the week prior, that there was a sense that the market was going to start heading lower in the days and weeks to come, but instead you get the exact opposite, and you have a week that was extremely bullish for the markets. And so what I'm going to do is go over the futures contract, showing you what all the main indices, the commodities, and so forth are doing right now. So starting right off with the E-mini, S&P E-mini contract, you'll see here that you had some critical resistance levels that was broken out at. First of all, you had what I wouldn't necessarily call it a double bottom, but it does have that, like, look and feel of a double bottom per se, because we tested support here twice. Now, had we broken this level, had we broken that key level right there, I think we would have gone probably all the way down to possibly as low as 13.29 on the contract, but instead we bounced right off of there and we go straight up. So we break through this resistance level here, and for the bulls now it automatically becomes, can we break the recent recovery highs? So if we can get past this level right here, that's about 14.22, the bulls will have basically nullified the bear flag, the bearishness, and all the recent weakness will have become is just a minor pullback onto new highs. So huge that the bulls can take advantage of this unexpected strength in the markets where it pushes through some short-term resistance, and then if you look at it from a little bit longer range, from back into February, you could also say that this whole area here represents a range-bound market. So get out of that area, you have to break out into new recovery highs. So that's basically the week ahead what the bulls are aiming to do. For the bears, the simple task is get back, and maybe it doesn't happen this week, but ultimately they need to get back below this 13.52 level, and then they'll be on the right track again. Going ahead and looking at the Dow, you can see the same thing. It looks a lot more bullish because of the very simple reason that we are much closer to breaking into new recovery highs. The strength was much better in the market this week. You can see there, I mean, very, very strong week for the Dow. And instead of just testing that 12,669 level, it actually put it in a higher low. So you have this level here, which was corresponded where the S&P E-mini contract went down to. And then instead of coming back down and testing it right here, instead it comes down and makes a higher low. So the Dow looks very positive as well. It needs to absolutely break through the recent highs though. And then let's go ahead and look at the Nasdaq. And of course the Nasdaq is dominated by what's going on with Apple. So you take the Nasdaq, it's been the most bullish of the indices this year. What you have is essentially a bull flag that has been forming. I mean, a very, very strong bull flag, and then it broke out of it. So for this one here, there's no reason to try to short this index at all. I would be going long on it. Don't try to get in front of it, because you could be on the threshold of another one of these types of rallies that if you're going to be short, you're going to pay for it dearly. And let's go ahead and look at gold. And we'll pull up the daily chart on it. Gold isn't as cut and dry as you'd like for it to be. I mean, you have resistance here, and if you go back far enough on the weekly chart, there's a lot less strength to gold. I would look at GLD, the ETF, to get a better idea of what the gold contract looks like from a weekly standpoint. But As for the actual contract itself, though, outside of this little dip below back in November, you have a triangle that, or a wedge, whatever you want to call it, that the commodity has been trading in since, June of last year. So what we're looking for is, okay, there is some healthiness to it, because instead of breaking down like I thought it might do here if the market went down, it bounced perfectly off of this trend line. And so your next target becomes right around here on a move back higher, especially if the market goes back, because usually the gold and the equities go higher. So the gold chart is not my favorite chart by any means to be trading right now, but you do see some support that's come in over the last month or so on this trend line here, and you'd like to hope that it will hold up for it if you're going to go long. But on the other hand, you also have, so you have a target about right here, and it gets a little bit smaller each day because of the descending trend line. But if you got in about, let's say you just got in, let's say that you got in around 1657, you could put a stop right around here at 1618. And so then all of a sudden you have a great risk reward. You have about $90 to the upside, $85 to the upside, and about $40 to the downside. So that's about a 2 to 1 risk ratio. So that's a good trade to try and take. Now let's take a look at crude. And crude, I think, has been a lot easier to trade versus the gold contract. In fact, it's showing us now it's got a little bit, after coming off of its highs of late, it's got a bit of a bear flag going here now. I'm not sure how that plays in. I mean, if the market equities rally, usually the commodities, like I've said before, will rally with the market. So it goes without saying that you would think the crude would go higher and nullify the bear flag, which could very well happen. But then again, you also have some heavy resistance here at around 106 on the contract. So right now it's just a shade below 105. So it's not going to take too long before you can find out, are we going to break through this resistance level? If it starts struggling with it, if you see like a nasty sell-off, of 1 or 2% come right off of this resistance level, then I would say probably start going short crude. You can do it through obviously this contract here, or you can also do it through USO or something else. But I definitely like the idea of shorting CL, and maybe even take, before you even see how it responds, maybe take a smaller position than you would normally take, and start building it up as a failure would occur right around here on the 106 price level. So I like the idea of going short crude, long gold at that bounce off of the wedge that we had just talked about. And there you have it. If you have any questions, feel free to contact me at ryan@sharepointer.com. I'll be glad to help you in any way I can with any questions that you might have. Y'all take care now.